Hi guys, thanks for joining us for another video here at Louisbourg. Today we're going to go through our quarterly commentary that we typically do every quarter. I have Mathieu he's a portfolio manager for our Canadian strategies, also the VP of Equities. So we're going to walk through what happened this quarter and what led to different performances, us versus the benchmark, and different names, and kind of give you everything we can to kind of help you understand what's going on within the Canadian strategies. So Matt, after some big moves in the second quarter, the third quarter continued that upward trajectory, but maybe not to the same extent. So I think maybe a good place to start would be really touching on what is the difference between Canada and the U.S. I mean, when we're watching the news, it's typically talking about the S&P 500 or the NASDAQ or something like that. So maybe Canada gets a little bit less attention. So maybe just help us all understand what's the difference between the two markets.
Sure, and we could make it complicated, but really, it's technology and resources. The U.S., caters to a lot more technology companies and some large ones that are meaningful in the world. A lot less in Canada. We have Shopify, which is the largest company in Canada by market value now, which we'll talk a little bit about later. But still, it's small in relation to the U.S. And we have a fair amount of energy companies and material companies as well. So much bigger weights in Canada versus the US. And for certain periods of time, that has been a positive, but we have not been in a big resource cycle over the past several years, and that explains the better US performance.
Yeah, and that's an interesting point to touch on, because really when we look at the funds themselves, just looking at the large cap in particular, it'd be good to go through what sectors really outperformed and really underperformed, and that might help explain some of that difference in performance as well between the two geographies. Sure.
So in Q3, we're happy to add a little bit of value versus the benchmark performance. We still had Shopify as a headwind. So Shopify's performance, stock continued to move higher. But the size of that headwind was less material than in Q1 and Q2, which the performance was off the charts in terms of the value that it added to the TSX. I think on a year-to-date basis, Shopify is responsible for about 4.5% of the TSX performance, which is incredible when you think about it. So Shopify was a bit of a headwind, but less so than in previous quarters. The rails, which we both own, we own CP and we own CN, love the businesses, pricing power, scarce asset, really can't replace it. But we've been trimming our positions, and they're very small positions in the fund right now. We'll get back to being large owners of rails. It's just that the market has been very enthusiastic in bidding up companies that are benefiting from the economy that is recovering. And they are now at their most expensive. So if you look at forward earnings for these businesses, you're paying more now than you have in the past. And I think there's a lot of good news built into the stock prices, and that's why we want to have a smaller weight. But to this point, the market's been continued to bid these companies higher, and they've been a headwind to our performance versus the benchmark. On the other side, what's helped is on the materials, we've had some good stock picks within precious metal entities. They've been strong performers. Perhaps we're at the beginning of a new mining cycle because of the gold price improving. We do emphasize quality business models, and thankfully we do have those choices in Canada. There's precious metal streamers or royalty companies, and we think that these are better business models than investing directly in the producers, because you're taking away a lot of risks that you don't need to have.
Yeah, and what are those risks? What can go wrong with a producer that owns a mine that's producing X amount of ounces of gold?
Well, certainly when you build a mine, you can have CapEx escalation.
Right.
If you're a streamer, you that's not your concern. You're essentially providing financing to get future ounces from that mine. But also there can be, when you're operating the mine, you can have cost escalation. So things can cost a lot more than plan in your mining plan. Whereas for the streamer, your cost is guaranteed. You have a set amount of dollars that you're going to pay per ounce that you receive. So we find that's attractive because you are still invested in a way that you benefit from the explorational upside in those businesses. You pay more, and those are more expensive businesses, but we feel that that's fair because you're actually getting less operating leverage or less risk, and you have a lot more free cash flows for the cash flows that you get, essentially because you don't have to reinvest in the business. We also benefited from our non-precious metal entities, so Tech Resources, Stella-Jones, Nutrien. They're all exposed to very different end markets, but we like them for a lot of different reasons, longer term and shorter term, and they also behave well this quarter. Finally, consumer staples, and we'll talk, I'll mention it a little later in terms of you want to be invested in defensive businesses in this market. Our consumer staples sector exposure helped us. We're a lot heavier in that space than the benchmark, bigger weight. Essentially not because we're trying to construct it that way, because the opportunity's there. You have these attractive defensive businesses that are actually benefiting from the different trends related to COVID. If you think about grocers, for example, but you're not being asked to pay more for these businesses, which we find surprising, really.
Yeah.
They're strong business models, they're inexpensive, and we feel that things are just getting better for them.
They've been value creators over time too, and it seems like they have good track records. Yeah.
Exactly. Empire, within that group, was our best performer. You cover it, you know it well.
Yeah.
But they're the Sobeys and IGA franchises, and they've been strong, and they don't have as much exposure to drug retail, which has been facing a few more headwinds. So it's been one of our best performers.
Yeah, I mean, that lack of exposure to drugstores. I mean, drugstores are typically a very attractive business, but in the environment we're seeing now, you don't have people that are necessarily going and buying the candy bar that they used to go buy, and a lot of that high margin stuff right at that these pharmacies are selling that has been a great business for Loblaws, so owning Shoppers, and for Metro now owning Jacques Coutu. So yeah, it's true that Empire is able to kind of have that amazing tailwind of those restaurant sales now going to grocery stores without having the headwind. So they've been an outperformer for us for sure. So when we're thinking about all that, and it's very backward looking. But we also made some changes in the fund, right? We're typically trading every day. We'll either trimming or adding around ranges, but we also introduced new names into the fund. So maybe you could walk us through some new names that we've introduced.
Sure. I mean, let's talk about CCL Industries a little bit. They're part of the materials sector, but really it feels more like an industrials. Essentially, they are a specialty company within packaging. Most of their business is very specialized labels across the consumer packaged goods. So
this would be like over a Pepsi can kind of thing.
Yeah, exactly. And the appeal there, it's not that it's you're essentially getting GDP type growth plus. They've been a market share leader over time. There is pricing power. It's a low cost item within your business. They've been great capital allocators over time, buying businesses, integrating them in their network, and using the best manufacturing facilities that they've had, and being able to convert a lot of their profitability into free cash flow to acquire additional businesses. So they have been faced, because of COVID, with a slower economy, and that's created some weakness in the stock price. But we're seeing business turn already for them, and we've had the ability to initiate a new position, which is really just an old position that we're recycling, because we used to own the company, and we trimmed it just because of valuation until there's nothing left to trim, because the market can likes to exaggerate things from our perspective. You know,
They get too excited about something.
get too excited about something, and that's been the case with CCL in the past. And
It wasn't that we weren't excited anymore. It was just the market was a little too excited.
Exactly.
Yeah.
So we moved away from it, and we feel we're getting the opposite opportunity today. We're excited about its long-term prospects. Market's a little too pessimistic, so we're reintroducing it to the portfolio. So very happy to get that opportunity.
Yeah, and I mean another one we introduced would be Brookfield Asset Management,
Yeah.
which I guess I could talk to, given I'm the one who did
That's
the work
right.
on it.
That's right.
But yeah, we had the opportunity because of their real estate exposure. They own a lot of commercial office real estate, and even a lot of other real estate assets in their private equity real estate funds. That gave us an opportunity to really step in and buy a great asset manager franchise that has a lot of growth, secular growth tailwinds behind it. So that weakness in the real estate that's causing some concerns right now was already reflected in the price, and we felt like we were getting this awesome asset manager vehicle at a good discount. So that was another reason for us to kind of step in and add that to the fund. Started building a position there.
For sure.
So again, like that's a great summary of kind of what is happening now in the fund. But looking forward, the strategy going forward, and how we see us being able to outperform the market in this environment. What are some things that we've changed, or the kind of new thoughts we've had now that we get more economic data coming out? We've had a lot more time to think about the long-term ramifications of COVID. What is the movement of our strategy been?
Yeah, I mean, for me, when I think about equities today, I try to be sober about their prospects. I think it's an environment where you do have to be cautious in terms of not necessarily just overall equity allocation. I think there's attractive prospects there, but within with your choices within your equity allocation. Because the reason I say that is because the performance has been very concentrated in a few areas where the market deems to be winners of COVID, which has created some exaggerations in terms of how much you should value certain businesses. But that does create opportunities elsewhere. We do find a lot of defensive businesses with very attractive fundamental and attributes at very fair prices. Think about the consumer staples we talked about, the grocers, the Alimentation Couche-Tard, Saputo. Those are attractive businesses with solid fundamentals that the market's not demanding high valuations for. And I think historically you can get there. So I think now is a time to be owning these businesses. And there's other areas, and we just talked about a few examples where the market will get concerned, due to COVID. Could be real estate, could be just overall level of economic activity, and can punish in the short term, we feel unfairly, some certain very high quality businesses. So we feel that the portfolio should look like that, have a lot of attractive defensive businesses, and also to emphasize some quality long-term businesses that are facing some challenges, for example, like CCL and Brookfield. Yeah, so I think that's how we should structure the portfolios.
Yeah, and we just talked a lot about large cap, and large cap it's a larger fund, and so it deserves a little more attention. But we've had a great year and a great quarter in the small cap fund. So maybe you could walk us through the differences between large cap and small cap. Maybe not everyone's intimately aware of why those would be different and why they'd have different performance aspects. Certainly.
So small cap versus large cap, risk appetite can play a part in terms of the enthusiasm for the small cap asset class, but sector differences is also important. And if you think about Canada, think about the public companies out there. Certainly you will find more materials and small energy companies. So the resource component of a small cap benchmark, and usually a small cap fund, will have a bit of a gearing towards commodity entities. And you have cycles. If you look at the last several years, it hasn't been a mining boom. That could be changing. And that explains a little bit why small cap would have underperformed large cap. This quarter, we are seeing the benchmark perform very well versus the large cap. And we're seeing the fund perform very well as well. We're very happy about that. That being said, if you look how we structure our fund, we manage small companies the same way that we manage large entities. We focus on stronger business models. So you will find our exposure to gold and precious, for example, will be with royalty models as well. And it's also with Major Drilling. Major Drilling's been our best performing stock.
A local Moncton company.
Local Moncton company based in Moncton, which is...
Maybe not everyone knows that, yeah.
No, and there's not a lot of public entities based out of Atlantic Canada, and that's not why we own it. We own it because the management team has always maintained a strong balance sheet to be a survivor and a leader in its space.
Yeah, in a cyclical business like commodities, you always want to have that balance sheet that can help you weather those pretty large downturns that can happen. So that's been obviously attractive.
Exactly. So if you want to participate in potentially an increasing mining cycle, but you don't want to take any specific risk to a property or a junior mine, why not invest in a business that benefits just from increasing activity? And that's their case. Where you're going to see a lot more drilling happen now that you're seeing all these gold financings and a higher gold price and a lot of interest for the sector. And that comes with a lag, and I think investors in the market is starting to understand that, and that's why you're starting to see the stock react to this. But we feel that fundamentals are going to get even better. So it's our top holding, and it's been our best performer in Q3 in terms of performance. So we think investors are in a good spot where you should have some small cap exposure as long as it's quality, and that's what we're emphasizing. No concept stocks, all high quality businesses, strong balance sheets, profitable businesses. That's the emphasis in our small cap strategy.
Yeah, I mean it's a good point that we don't focus on concept stocks. I mean, we get a lot of pitches from some investment banks about these next up and coming thing that doesn't make any money right now and barely has any revenue, but we promise this is going to be the best thing we've ever seen. And we really focus on those high quality businesses that already have a track record with management we can trust.
We'll let somebody else gamble.
Yeah, we'll let someone else gamble. Yeah. Well, I think that's a great way to end it. Is there anything you maybe want to add before we close on the strategy with small cap? Is there anything that we've changed there, or what are we kind of doing going forward before we go?
No. I think that's I think being consistent and constant in terms of not overpaying for these businesses, focusing on the strong balance sheet and track record businesses, and not trying to chase what's on the news today is the right approach to adding value in small cap over the long term.
Perfect. Well, thanks. Appreciate you sitting down and chatting about it.